Today we're going to be talking 529s and how they're not just for college anymore. Today we're going to dig a little more into the 529 college education savings account, which used to be just that, just for college education. It's now expanded in the last few years, and even going into 2024, there are some big changes that we want to make you aware of, because it might not just be for college anymore. I think it's worth noting with 529s in general that while you don't get the benefit of a tax write-off, you don't get to write off your taxes, it's not a deduction when you make a contribution to a 529, you do get the benefit of tax-deferred growth and then tax-free distributions when they are used for the approved higher education expenses. First one we're going to cover is that 529s can actually be used for tuition expenses of K-12 education. So it used to be that it had to be a qualified higher education expense. What that meant is that it could be used on tuition, it could be used on room and board, and books most of the time are the three big ones, right? That all changed in 2017 with the Tax Cuts and Jobs Act. What happened is that they no longer made it only about college tuition and college expenses. Generally what that was tuition, room and board, books, and supplies. They opened it up so that people can fund K-12 education, just tuition though, no room and board. You can't send your kid off to a boarding school, but you can pay up to $10,000 a year out of a 529 and get that tax-free distribution treatment, having had the benefit of tax deferral. Another little catch is that it can actually also be used up to $10,000 to pay down loans. I'm lumping those two kind of together. The second item that we want to touch on is the estate tax benefits of having a 529. So a 529 is owned by the parent, the grandparent, the aunt or uncle, whoever is sponsoring that account. And then they actually get to dictate who the beneficiary is. There's a little loophole with 529s, which is kind of nice from an estate planning perspective, and that they are not includable in the sponsor's estate. So if grandma and grandpa have a large estate and they are looking to get assets out of their estate, they can superfund a 529. What superfunding is you can go and do 5 years of accelerated gifting, right? So we have the ability to do $18,000 per person per year and not have to use our federal exemptions to not have to pay gift tax. Above the $18,000, if you're not using your federal exemption, you're paying gift tax. But with superfunding of 529, they allow you to accelerate those $18,000 in annual exclusion, right? So you get 5 years worth in year one. So you can put, I think it's $90,000 if I'm not mistaken, in one time. That can be for grandma, that can be for grandpa, that can be for aunt, that can be for uncle, into the benefit of a child's account. So you can get $180,000 in year one. The catch is you just can't do any future gifting to that individual. No $18,000 gifts going forward into that 529 or into any other account, right? Benefit is in Washington State, we have a $2.2 million estate tax exemption. Above and beyond that, you're going to be taxed at, I believe it's 7% from a Washington state level taxation standpoint. Federal levels are closer to 13 million exemption right now. So if you have a large estate and you're looking to get assets out of your state and benefit your family, superfunding a 529 is a spectacular way to go to get the benefit of tax deferral out of your state and then helping out your niece, nephew, grandchild, whomever it might be. The third and final one, and one of the more exciting ones that I've seen come out, and this is coming out in 2024, so be ready, is that there is now the ability to roll up to $35,000 in excess capital from the 529 to a Roth IRA to benefit the beneficiary of the 529. I know in the past it's been a worry of people that if they overfund the 529, their kid goes to college and gets tuition covered in some way, or it just doesn't cost as much. So the account performed. Let's hope for that, right? And that we've got excess capital. What do they do with that, right? In the past, it used to be that you could switch beneficiaries. If you had another kid that you would like to help out in college, you could switch beneficiaries and fund their college and not get hit with the tax. Or you'd have to take it out and you have to pay the 10% penalty, which is not something that people really enjoy, and they have to pay ordinary income tax on it. Now what they did though is they've given the option, as long as the account has been opened for 15 years, the beneficiary has earned income right? So maybe they've graduated college and they've got their first job, and they can convert out of that 529 every year up to the IRA contribution limit. For anybody under 50, it's $7,000 right now, up to the point where it hits $35,000. And you can do that every year until it hits $35,000. In my mind, that's a massive win, because 529s used to be a worry of people that what are they going to do with the excess capital? You can set your beneficiary, your sponsor child, we'll call them, up now with retirement in the form of a Roth IRA at a very early age. Well, they will then get the benefit of tax-free growth on those assets. So to wrap things up, before we jump into the big three, I just want to reiterate some of the tax benefits of the 529 and why people utilize it, right? Again, you don't get a contribution deduction. You don't get a deduction when you put money into the 529, but you do get the benefit of tax-deferred growth. And as long as it is used on the K-12 education tuition costs like we talked about, loan reimbursement like we talked about, and higher education costs in tuition, room and board, and books and supplies, then you get the benefit of tax-free distributions, right? So that was key point number one, big win. They changed it to K-12 education tuition expenses up to $10,000 per year. The second item that we had covered is the benefits of utilizing the 529 to get assets out of your estate, and so that they won't be subject to estate tax, right? Big win, getting assets out of the estate, not paying federal estate tax, getting the tax deferred growth for the benefit of your beneficiaries. And then lastly is the new one coming in 2024, the ability to convert any excess capital in the 529s to a Roth IRA for the benefit of the beneficiary of the original 529. Again, assuming it's been open for 15 years and they have the earnings to justify it up to the contribution limit. So if you have any interest in learning more about these items, you're wondering how they might apply to you, feel free to reach out to us. Otherwise, we hope you have a spectacular weekend, and thanks for watching.